Hello and welcome. My name is Ray and let's get into it. So, I'd like to start off with a couple of things. Just doing a position update, uh, also doing a shares portfolio update as well as talk about superannuation. So, we've got our graph here. Our total net worth sitting at $103,000, hitting the $100,000 mark for the first time. Shares sitting at 68. Super deposit went in, so that's at 36 now. Spaceships at 265 and debt sitting at $3,000. The debt's currently starting to blow out, but I do have some money in cash sitting on the sides, but I also do have bills on the way. I've got Rego and a tax return payment due in March. So saving up a bit of money there. I've got $1,000, but I've also got some good news as well. I've got, what is it? I've got bonus and just a general pay coming through in 2 days or so. So that on top of the $1,000 cash should see that paid off pretty easily. Then we can focus on this debt, which is the main goal of the 2019-2020 financial year. And then we can start getting into a surplus and start having some cash on the sides. But the main topic for the past week would be the shares, hitting $68,000 for the first time. You can see this lovely growth here. And it's not even the capital growth, which is amazing, it's the income. So just recently, a couple of dividends have come through, and currently it's sitting at $2,300 for the year, and that's about $1,000 increase on the past video or two videos. We're currently in quarter 3, which is this $516 here, and we've also got quarter 4, which already eclipses the quarter we're currently in now, which would make sense if you have a look at this dividend payout right here, which is Fortescue Metals paying out $724. That's the largest ever dividend payout. And second is Fortescue Metals again at $475. But that is a ridiculously large dividend payout that I'm used to, and all of this money is going to get reinvested, which is great. If we have a look at the month view, April 2020 is the largest dividend month, beating October 2019. The quarter 4 is shaping up to be a big one. We've got 751 in there already. Currently, quarter 2 of 2019 is the largest at 913, but we still have some more dividends coming through. We've got Bank of Queensland due in March. No, that's May. So Bank of Queensland plus Fortescue should see this quarter 4 be in excess of $1,000, and then that will be the highest quarter paid to date. That's $1,000 in 3 months, which is weird. It's weird. This money's coming through. I've got a couple of goals hit as well due to this. So the past 12 months, my goal for 2019-2020 was to hit $3,000 in income and hit $1,000 in franking credits as well. And the long-term goal of this portfolio is to have the income of equivalent to $1,000 per week. Right now we're sitting at 62, which is just this number here, 3,000-ish, divided by 52, and then you get $62. And that's per week on average. And this number is going to go up. This number is going to go up. It's going to go up faster and faster, and eventually it's going to get to a point where it'll be in excess of $1,000. And even 2 weeks, in 2 weeks, this number's gone from 5.8% to 6.3% basically, and it's just going to go up, which is weird. And yeah, eventually I will not have to work. Using this dividend strategy, companies pay me a share of their profits just by being a shareholder. This money will get reinvested, they'll purchase more shares, and then the next payout should be bigger. And then this is the vehicle which I'm using to get compound interest. It's not the only reason why I like using dividends, because this money being paid out is actually pretty amazing. But yeah, at the moment it's currently all set to reinvest for those that can, and when it gets to a point that I want to stop working, I can just switch those back to pay me in cash. So that's one of the benefits that I like of dividend investing. The other one would be the added tax benefits of franking credits, which is this entire column here. And with these franking credits, just a little bit of an explanation. Hopefully I can explain this right. But these dividends, or this dividend income received, can be franked or unfranked. You can see the difference here. These dividend payouts are franked, these are unfranked. And these franked dividends, this income has already been subject to a 30% company tax. So the company has already paid tax on this income, or this money, this basket of money. And these franking credits, which are here, they can help offset your tax obligations at tax time, as the companies have already paid some of this for you. So the idea of franking credits is to avoid double tax on this basket of money, where the company would pay tax on this $1,000 actually, because 310 of it went to the ATO for tax, and the 70% of it has been paid out to the shareholder. And it would be annoying if this income which I've received would also get taxed at my marginal tax rate. So the franking credits helps offset your income tax because it's tax already paid. The unfranked dividends, which is these REITs here, can just be classed as income since there are no franking credits, which means it's just applied, the tax on this income is applied at the marginal tax rate, which for me is currently above 30%. So, so even though the company has paid 30%, I've still got to pay that little bit more. but I don't have to pay at least 30% on this money, which is good. Good, good, good. Um, there is the case as well for some people who don't have their marginal tax rate above 30%. So when the franking credits exceeds the tax that you have to pay, and generally this just or the difference in the tax you have to pay and the franking credits you have would just get paid back as a refund. So um, just think of it as a tax refund. And yeah, those two things are the reasons why I like to choose dividend investing here in Australia. And aside from that, it's also uh, the the income and the tax. There is also other strategies which you can use, but I don't like to choose myself. Things like growth stocks, penny stocks, anything speculative or non-dividend, or companies which don't pay dividends. Um, like I can invest in these companies, but I choose not to as they don't align with my strategy. My strategy is to build income. And if we just have a look at, say, one of these companies, which we'll just choose Afterpay Touch, um, even though this company has had great returns at $2.95 and it's now worth $38, $39, $40. That's a 12%. Oh, sorry, not 12%, 12 times the return. So if you invest $10,000 at the start of the company, oh my gosh. If you invest $10,000 when the company first went public until now, um, it would be worth $120,000 if I can do math correctly. Um, but the thing that I don't like about this buying low, selling high growth strategy is that during this time, there's no checkpoint, there's no nothing. It just matters when you sell and when you buy. And throughout this, there's been ups, downs, ups, downs, up, downs, and you don't receive anything in between. So it can get a little bit scary if you're, say, like just coming off these recent highs, and then you lose. Is that 34%? Holy moly. Losing 42% of your current holding from the peak, and then what happens if you sell out here and then you lose your gains? Um, I don't want to have to worry about that. I just want to know that this company is making money and um, it's giving out dividends. So that's one of the reasons why I would not consider purchasing something like Afterpay Touch. But yeah, dividends, 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 dividends. It's going well. Aside from the shares, um, I'd like to turn to the superannuation or the Australian pensions. I have done a little bit of updating. So, having a look at this chart, you can see the allocations have changed in the last month. So I've removed bonds allocation and the my super allocation, just leaving me with accelerated growth, balanced, and capital stable uh, allocations. Sorry. And there's a couple of reasons behind this, and some of it would just have to be involved with the asset allocations behind these accounts. So, just doing some research, just managed to find um, the allocations for each of these. So, currently invested with MLC, uh, but I had the basis behind um, the super plan was to be weighted more defensively, so having more bonds and capital stable, which held up the majority of the investments under super. Uh, so with my superannuation money, I do have it deployed. It is doing stuff, uh, and it's doing stuff in a way which I would like to have control or semi-control over, rather than just letting the money just sit there and do whatever and not worry about, and not take into account like any market conditions or anything like that. Uh, but yeah, the main idea is I had it weighted defensively in bonds and capital stable, but having a look at the allocations, 40% bonds, it had it has 25% cash, which was the big standout, which I was not aware of. And then you've got some more government bonds and just some more bonds. I don't 100% understand the like the full difference between all of these and what they do exactly. Um, but the thing which stood out, the cash at 25%. So if we look back at what we had here, so currently had, well, I previously had $8,500 invested in bonds, and 25% of that was in cash, and it was not doing anything. It's in cash. It does not do anything. I'd rather have it invested in assets, more so than um, having 25% in cash. But I do understand that Capital Stable still has, or all of these still have a cash allocation, but 25% um, was just a little bit too large. So deciding to um, move the defensiveness through to the Capital Stable portfolio, which has a little bit less bonds and cash involved, and it's spread out a little bit more. There's shares in there as well. So rather than having it split more so in Capital Stable, you can see other things like balanced is more, has around about 30% in shares, still some bonds, some cash, and where is it as well? There's also some global shares in there as well at 20%, so 20, about 50% in shares. There's also growth, which sits as a higher share portfolio. 56%. And then there's also accelerate. Oh my gosh, words. Accelerated growth, which has 52% in shares, 43% in global shares, but it is also leveraged as well. So the highs and lows will be accentuated more so than normal. But yeah, just with super, having a look at what the allocations of each portfolio is helps in just identifying exactly what are you trying to achieve with your super account, and not knowing that bonds had 25% is one of those downfalls. So let's not save that. Whatever, get out there. So that's why I've adjusted this to have to spread out the bonds and the my super into the different remaining accounts. Accelerated and growth have changed to 15% to be a little bit more aggressive in the top end, and a little bit less aggressive on the bottom end here, and balanced is just staying there as well. But yeah, just a little bit of an adjustment there. Wow, what is going on here? Yeah, but it's good to see that I can see exactly what my super is doing. I know how much I can work out how much I have in cash, but just by working out some math, and I know that the majority. Oh my gosh, the majority of my cash is deployed. So those are the main things that that I'm looking for in super. I know how much I have, and I have all of. I know that I have all of it, because that's what I basically did here in November, December, where I found $7,000 of lost super, which was in one of my super accounts in my current job, but in a different role. So I have since then changed super accounts through the company, and I just left it sitting there for years until I consolidated them. So yeah, there also is uh, the contributions with super as well. So also recently just had a deposit of about $1,000 into the super account as well, and I've only got a couple of dot points left, but it does involve a question. So at the moment, there currently is a debate going on with the with super in itself. Currently, the contribution rate is set at 9.5%. So 9.5% of your wage gets sent to a super account. And some things with the debate is that at the moment, wage growth is currently really low, yet we are still having 9.5% of our wage placed into our super account where we cannot access it. And this money is just growing over and over and over time. It's not contributing to the economy. This money is locked away. We can't spend it. We can't do much with it. And the idea is that we can do a couple of things. Uh, we can like lower the uh, super contributions down to where they were previously. I believe when they were introduced, it was about like, well, it says 3 or 4%. Back in 1992, but recently sitting at 9.5%, and then apparently from next year, for the next couple of years, we'll be increasing all the way through to 12%. So we can reduce it so that we have more money. At the moment, it's currently set to increase, which means companies will have to pay their employees more, more money to be deposited away into their super retirement accounts, and have that money not being used um, in the economy, and wage growth is still low, so people are struggling to make ends meet on average. So there is a couple of things which you could do, and some some suggestions were also to remove super entirely. What happens if the average Australian had their entire super account paid out to them? How much easier would it make life for them? But you could fall into what's happening in the US or other countries where it's not mandatory to have deposits into your retirement accounts. But then that leaves you exposed if you don't know anything about this, if you don't prepare for retirement, then you could be left out with a either pretty low standard of living retirement, or worse, you run out of money, being, say, like, what, living up to you're like 80, 90 years old, and you run out of money, you're not going to be able to work again. And if you don't set yourself up, which this is what super is to help assist with that. I say assist because if you don't work, then you're not going to get super for it. But yeah, the debate going out on does have a couple of questions. What should we do? At the moment, I'd probably just wanted to leave it where it is for a while. We haven't even got one full lifetime worth of super contributions, and we're already increasing it. But yeah, it's just interesting. It's interesting, but if they do raise the super contributions to 12%, cool. For myself, it actually benefits me because for my salary, or my base salary, actually doesn't include super. So my base salary works out what my hourly rate is, but then I've also got overtime, public holidays, bonus, and then super is added on top, based on my base salary. It's not included. And then you've got other people which have their remuneration package or something like that. And some people say, "Oh, I earn $100,000, $100,000, yeah, $100,000 a year." But that includes super. So in reality, they earn their take-home pay, or they earn less than what they expect. Where for me, looking at my salary, or my base salary, my take-home pay is actually a lot more than I expected. But yeah, I'm probably going to wrap it up there. It's just chuggling, oh my god, chugging along. Um, Next Sunday is the first of March, so we should be able to start locking in these numbers and see where we finish the end of February at, and then we can start moving on to March, get these bills paid off, and start hitting these goals. But I believe that's it from me. Anyway, thanks for tuning in. Thank you, and see you in the next one.